The critical September jobs report is MIA, a casualty of the shutdown. That means policymakers are flying partially blind and now have to steer without a full economic instrument panel, just as the Fed weighs its next move on interest rates. In his first interview since the Senate just voted and failed to pass a measure to reopen the government, the Federal Reserve's newest governor, Stephen Miran, joins me here in studio. I just have to start by asking you about the data that we know already isn't out, the September jobs report, but we won't be getting retail sales. We won't be maybe getting CPI and PCE. These are very important inflation data pieces. How can you decide what to do with rates if this shutdown continues and we don't get those numbers?
Yeah, well, first, thanks for having me back. But I think you're raising a completely legitimate issue. And to be clear, fiscal decisions like funding the government are entirely the purview of Congress. But we do use those data to set monetary policy. It's important for us to have a sense of where the economy is and where the economy is going in order to sort of arrive at the right decision. Now, that said, we don't make decisions every day. The Federal Open Market Committee meets every 6 weeks. So I'm hopeful that we'll have the data by the time we get there. We'll need it. It'll be much more problematic to make a decision if we don't have those data.
Yeah. Well, it's all hypothetical, but let's continue with the hypothesis that we're not going to get the data. You still believe that we should enact a 50 basis point cut at the next meeting?
Yeah, so my view is that policy has become much more restrictive this year because there's been a number of changes to the policy space which have made what we call the neutral rate, or the rate at which policy is neither restrictive nor accommodative, come down. And my view is that last year that rate was pushed up much higher by things like expansive fiscal deficits and large-scale immigration, and now there's been very different changes to those policies this year that have brought those down. So the deficit, if you look at the data that we do have available, the fiscal deficit in the months of February through August, after these policies changed, has been running about $400 billion less at an annualized rate than the comparable period in the last fiscal year, right? So that's a material decline in the deficit due to the change in policies. And meanwhile, we've had the biggest population growth shocks in our lifetimes, both to the upside and now to the downside as well, all crammed within a couple years. That's brought the neutral rate down and made policy much more restrictive.
What is your neutral rate? Because it is far below what the Federal Reserve's, or at least most of the people with whom we speak, have it at.
Yeah, so my sense of the neutral rate is that it's probably about 0.5% in real terms.
That's it?
But that's not really so far from the bulk of where a lot of other people are. It's inside the range of where everyone else on the committee is if you look at the dots in the summary of economic projections. It's just my view that we should get to the neutral rate much faster, I think, than the rest of the committee. And that's because I view policy as having tightened recently. And the longer you stay tight like this, the more you raise the risks of having a significant economic slowdown because policy is too tight.
Aren't interest rate cuts, or the ability to do it, a tool that we have to have, that the Fed has to have in case of break glass type of situations like the pandemic, like the financial crisis? And if you cut rates right now, when we have GDP at 3.8%, the most recent print, which is really quite good, and you have some other strong data points. I mean, jobs are certainly a little wobbly. Don't you risk not having enough leeway, not having enough tools if something bad happens, like a black swan event?
Yeah, so two things. One, part of the reason why the economy has been so strong has been because there's policies that push out the supply side of the economy. And those include deregulation, changes to tax policy. And when you push out the supply side of the economy, you increase what we call actual and potential output at the same amount, which means that policy should not tighten in response to that. Now, with respect to the other thing that you mentioned, which is don't you need the space to the downside in case something bad happens?
Exactly.
That's a reasonable thing to say. However, there's plenty of space to the downside, right? We're far from the zero lower bound for interest rates. And if you were close to the zero lower bound for interest rates, you might think, okay, well, maybe you want to sort of preserve some policy space. And I don't think that's, that's always the case, but you might argue that. But right now, we're quite far from the zero lower bound. And so we could cut some more, provide some more, remove some more restriction from the economy and still have plenty of space to the downside should a negative shock occur.
You talk about how $400 billion here, $400 billion there has come off that deficit, which is certainly the right direction. But Ray Dalio of Bridgewater, one of the largest hedge fund ever, was just on the show. Here's what he said about the debt, about the deficit, and then I'll have you respond.
There is a risk if you lower interest rates now that you can hurt the bond market rather than help the bond market because of one man's debts or another man's assets.
What should the rate be, do you think?
The rate should be over 2%. And you could look at what it is by looking at inflation index bonds and what are their yields. So a real rate of above about 2% is about as low as you can go.
Your thought?
Yeah, so look, this is similar to an argument that I made last year, because I thought last year the neutral rate was much higher than everyone else did, which meant that policy was not as restrictive as many others did. And what that meant was that cutting rates last year was a mistake, in my opinion, and you saw that in the bond market as yields moved higher because the additional rate cuts provided more inflationary stimulus. Now, my view is that so much has changed since last year, and monetary policy has to take account of that. We've had, as I said a moment ago, the biggest shock to population growth in our lifetimes, in the upside and the downside, in quick succession. This is normally very slow moving, but it happens so fast. And so things are different now than they were a year ago, and it makes sense for monetary policy to take that into account. And the bond market has not reacted adversely to the rate cut that occurred a few weeks ago.
I don't envy you guys at the Fed, because you have, as I said, a slightly weakening jobs market. I mean, if you look at what we just got with the ADP report, very wimpy. We don't have the September jobs report now, but there are some other indications that it's slightly problematic here. But by the same token, if you look at August inflation, we can just pick up a couple of things. For example, food prices, grocery prices. We can put these up on the screen. Coffee jumping pretty exponentially. Utilities, gas. I mean, you're talking double-digit percentages in some cases here when it comes to that, and therefore, I just am very interested to know how you justify cutting rates when inflation appears to be going in the wrong way. I mean, food up 3.2% year over year, furniture up 9.5%, beef steaks up 16+%.
Yeah, so there will always be what economists call relative price changes. That's when one thing gets more expensive and another gets cheaper.
But President Trump ran and was elected on, I'm going to make things so much cheaper, including eggs.
Yeah, so, well, that's a separate issue from what the Federal Reserve should do. And what I want to say about inflation is that it's the overall price level. And the single biggest component of it is shelter costs, right? Mm-hmm. Shelter costs, rent, homeownership costs, these are the biggest costs for most households. And if you look at that, if you look at this market, right, there's, in my view, significant disinflation in the pipeline for two reasons. One, the way that this is calculated is based on what we would call average rents as opposed to new rents. And so if you think about it, if you rent a home, you don't reset your lease every day, you probably reset your lease every year, maybe every 2 years. This means that there's a lag between when market rents move up or down and when average rents move up or down, the way it's recorded in the inflation data. That lag meant that average rents are running much higher than new rents for a long period of time. But that period of catch-up is now done, which means to me that average rents are going to come down and shelter inflation with it. The other element of this is, as I said a moment ago, population growth. There's so much evidence in the economic literature that when you add a large number of immigrants into a population, the supply of housing doesn't adjust instantaneously. You add millions of new people, you don't get millions of new houses at the same time. And that pushes shelters prices up. That's gone now.
By deporting illegal immigrants, then the supply of apartments goes up, prices go down. All of your arguments you laid out at the Economic Club of New York, and the former Treasury Secretary, Larry Summers, really took aim at you. In fact, he went out there, I mean, the headline in Bloomberg, he contributes to Bloomberg, but he said that you gave, quote, the weakest Fed governor speech in memory. He really felt that you were not taking into account tariffs as a tax, that is going to make things more expensive. We know of a lot of companies that are going to raise the prices and stop shouldering so much of it themselves are going to raise prices. So what is your response to Larry Summers?
Yeah, look, I saw that, and Larry Summers has been wrong about pretty much everything this year, so I understand why he's upset and lashing out at people. But this is a guy who analyzed the same set of policies that I analyzed and said that they would lead to, his words to CNN, lead to a greater inflation shock than the economy suffered after COVID, when inflation went to 9%, right? Doesn't take a Harvard PhD to realize that hasn't happened. He hasn't given us an accounting. Where's the missing inflation? Why was he wrong?
Or a Harvard president.
How will he prevent being wrong again in the future? He also predicted in April of this year that we'd go into a recession and see 2 million job losses. Hasn't happened. As you mentioned before, we had 3.8% growth in the second quarter. The Atlanta Fed's nowcaster indicates 3.8% growth in the third quarter. So with forecast errors this big, this wildly wrong, I think the best thing for America is if me and other policymakers at the Federal Reserve just ignore Larry Summers.
All right. Larry, if you hear that, there you go. That's his response. I will just finally ask you this. If we do loosen up and the government reopens and we get a hotter than expected inflation report, personal consumption expenditure, which the Fed really likes to look at, or CPI, will that bring you down to a 1/4 point cut?
Yeah, so what I would have to see is some sort of inflation that I thought was going to affect the forecast looking out a year or 2 years, right? What's the source of the inflation? Is it going to be persistent? Is it going to be transitory? That depends on the nature of the shock and what's going on with inflation expectations at the time. So it's really difficult to answer a hypothetical like that without a lot more framing around whether you expect that inflation to sort of be durable or not.
Stephen, thank you.